Right, let's just jump straight in, no fluff. Everyone's gagging to know how you call a top or bottom, Morgan.
Right.
Every time a stock goes parabolic, you get 1,000 keyboard warriors thinking, right, I'm a hero, time to short this to the ground. But how do you actually know when a move is gassed out
Yeah.
before you get your face ripped off?
Mate, that is the million-dollar question, innit?
Yeah?
And if you just guess, you're going to have a very bad time. Look, one of the proper old-school tools for this,
Okay.
the stuff they teach you for your CMT exams, is the stochastic oscillator. Stochastic, what? Sounds like something you'd find in a science lab. Is this another one of your nerdy chart things?
Oh, listen, this nerdy chart thing was cooked up in the 1950s by a trading legend, George Lane.
Wow.
And his whole idea is pure street smarts. He said before a rocket can fall, it has to slow down first. It loses thrust, hangs in the air for a second, then it turns. The stochastic is built to measure that exact moment, the slowdown.
Ah, I get you. So it's not a price tracker.
No.
It's a speedometer for the market. It tells you if the move is going 100 miles an hour or if it's crawling at 10 about
Right.
to do a U-turn.
Bang on. That's the perfect way to put it. And because it's a speedometer, it has a fixed range.
Okay.
It only goes from 0 to 100. And that's what makes it so good at spotting extremes.
Right.
Anything above 80, the market's considered overbought. Anything below 20, it's oversold.
Hold up. Let's get into the guts of it for a second. There
Yeah.
are two lines on the chart, but always confuse people.
Yep.
%K and %D. Break it down for me like I'm 5.
Simple, mate. Think of the %K line as the raw, twitchy, caffeine-addicted trader.
Okay.
It's the fast line. All it does is tell you where the price is just closed relative to its high and low over the last, say, 14 days.
Right.
If it's 100, the price just closed at the absolute peak of that range. Bullish.
And the %D?
The %D line is the old timer, the chilled out boss.
Right.
It's just a smoothed out moving average of that twitchy %K line. It calms everything down and gives you a much clearer signal. You're basically waiting for the twitchy guy to cross over the calm boss.
Which is why everyone uses the slow stochastic, right? The fast version with the raw %K is just too noisy.
Yeah,
it's like
exactly.
trying to have a conversation in the middle of a rave. The slow stochastic filters out the noise so you can actually hear what's going on.
Exactly. Fast is for adrenaline junkies.
Yeah.
Slow is for people who actually want to make money.
Okay, so here's the trap.
Go on.
I see it all the time in our chat group. A newbie sees this stochastic line go above 80 and they scream, "It's overbought, sell everything." Talk to me about that.
Yeah, and that newbie is about to get absolutely rinsed.
Right.
A market can stay overbought for weeks in a monster uptrend. Think of Nvidia this past year.
Oh, wow.
If you shorted it just because a line went above 80, you'd be bankrupt. Overbought just means there's strong buying pressure. It doesn't mean it's about to reverse. So what's the actual signal then? Don't leave us hanging. The smart money waits. You let it go over 80. Then you watch.
Okay.
The real signal is when the K line crosses back down below the 80 level. That's the first hint the party might be ending.
Right.
Even better is when the fast K line crosses below the slow D line while they're both above 80. That's the combo punch.
Got it, but that's just the basic stuff. The secret sauce,
Yeah.
the thing that separates the men from the boys,
Yeah.
is divergence. This is the real alpha.
100%. Divergence is your get out of jail free card.
Right.
It's when the chart is telling you one story, but the speedometer is telling you another. Let's say the price of a crypto coin pumps to a new all-time high. Everyone's celebrating.
Yeah.
But you look at your stochastic, and it's made a lower high than it did on the previous pump.
And that tells you?
It's a massive red flag. It means the price is making new highs on fumes. There's no momentum, no power behind it. The move is exhausted. That's a classic bearish divergence, and it's a powerful warning that the top is likely in, or very, very close.
Okay.
You start thinking about taking profits, or looking for a short.
It's like seeing a boxer in the 12th round still throwing punches, but
Yeah.
they've got nothing on them. The punches are landing, but they're weak. The knockout is coming. And the opposite, a bullish divergence, is when the price makes a scary new low,
Right.
but the stochastic makes a higher low.
You got it.
That's when the selling is exhausted. The panic is there in the price, but the underlying momentum is starting to turn. That's often where you find the monster bottoms. So summarize for the people at home. Rule 1, use the slow stochastic, not the fast one, unless you enjoy pain. Rule 2, overbought and oversold are warning zones, not automatic buy or sell signals. Don't fight a strong trend. Rule 3, the real money is made by spotting divergence.
Right.
When price and momentum disagree, trust momentum.
Nailed it. And most important of all, don't use it in isolation.
Right.
It's a sidekick, not a superhero. Use it with your trend lines, your key levels, your moving averages.
Okay.
Build a complete case for your trade.
Solid gold, mate. Look, if you want to argue with us about this or show us your own charts, you need to be in our chat group. The link's down below. Hop in and have a laugh with us. It's where the real action happens.
Now, here's a question we'd like you to think about. If you spot a perfect bearish divergence on a daily chart, but the weekly trend is still screaming upwards, what do you do? Do you take the short, or do you respect the longer-term trend? Drop your answer in the chat. Catch you in there.